Hey there, fellow deep divers, ready to unlock some serious wisdom. Today, today we're taking a plunge into Warren Buffett's 2016 letter to Berkshire Hathaway shareholders.
Oh, yeah, these letters are like gold mines of insight. You know what I find fascinating is how Buffett explains these like really complex financial concepts
Yeah,
in a way that anyone can understand. He doesn't talk down to you, but he doesn't drown you in jargon either.
exactly. It's like he's just sitting down with you for a chat,
Yeah.
sharing his thoughts on business and investing and the economy. So our mission today is to guide you through the key takeaways from that letter,
Okay.
going beyond just the numbers and the financial performance.
Because as you'll see, Buffett himself emphasizes that the traditional metrics don't tell the whole story of Berkshire's value anymore.
Right.
There's more to it than meets the eye.
Okay, let's unpack that. So the letter, as always, it starts with Berkshire's performance in 2016, and it was a stellar year, right?
Absolutely added whopping $27.5 billion to their net worth,
Wow.
with book value per share increasing by 10.7%.
But here's where it gets really interesting. Buffett immediately points out that fixating on book value alone
Right.
doesn't give you the full picture anymore. Why is that?
He uses a brilliant analogy.
Mhm.
Imagine Berkshire buys a company. If that company struggles, accounting rules require them to write down its value on their books.
Mm-hmm.
Makes sense, right? You want to reflect the reality of the situation.
Got to keep things honest.
Precisely. But here's the catch. If a company they acquire performs exceptionally well,
Okay.
its value on Berkshire's books is never marked up,
Mm.
even if its intrinsic value skyrockets.
So what does this mean for someone following Berkshire?
It means that Berkshire's intrinsic value, what it's truly worth, is actually far higher than what their balance sheet shows.
Okay.
And this gap keeps growing, fueled by the unrecorded gains of their winner companies.
Especially those in their massive insurance operations, which we'll dive into later.
Yeah.
Now let's talk about Buffett's core philosophy, the long game.
He expects Berkshire's earnings to grow every year, but he's also realistic. He knows economic cycles happen.
Sure.
Unexpected events pop up, things you can't always predict.
Like, say, a global pandemic
Exactly.
or a sudden war.
Exactly. But the key takeaway is this Berkshire strategy revolves around reinvesting their earnings more aggressively than almost any other company out there.
And to illustrate this point, Buffett uses a rather vivid quote. He says he'd rather prepare for a colonoscopy
Oh, yeah.
than issue new Berkshire shares.
That tells you everything you need to know about their commitment to retaining earnings and avoiding dilution of shareholder value.
Right.
They don't want to slice that pie into smaller pieces unless it's absolutely necessary.
It also highlights their evolution from primarily an investment company
Right.
to one that owns a vast array of businesses.
Speaking of acquisitions, let's talk about a pivotal moment, the Dexter shoe debacle.
Ah, yes. The story of what Buffett himself calls a particularly egregious error.
He bought Dexter shoe in 1993 for $434 million, and its value promptly went to, well, zero.
Ouch, even the Oracle of Omaha makes mistakes.
But here's the kicker. The Berkshire stock he used for that purchase is now worth over $6 billion.
Talk about a silver lining. What's the lesson here for everyday investors?
Even the best make mistakes. It's how you handle them and your ego that really matters. Don't let a single misstep derail your long-term strategy.
This leads us nicely into what Buffett calls the three key happenings that shaped Berkshire's current trajectory. First up, Geico.
This is the company that Buffett says sets his heart afire, and it became the bedrock of their insurance empire.
Yeah.
We'll delve deeper into Geico later on, but it's a prime example of Buffett's love for businesses with a strong competitive advantage.
Next, we have General Re, another acquisition not as successful, right?
It was a learning experience, let's put it that way. Buffett admits he overpaid by using too much Berkshire stock for the deal.
Okay.
It reinforced his aversion to issuing shares unless absolutely necessary.
And finally, we have Mid-American Energy, a pivotal purchase, wouldn't you say?
Definitely, this acquisition solidified their strategy of not just investing in companies, but owning them outright.
Right.
Plus, they started utilizing internally generated cash for acquisitions, which gave them tremendous flexibility and independence.
This unique approach to capital allocation gives Berkshire a major edge in the market. Now, let's move on to Buffett's perspective on America's economic landscape. He's known for his optimism, right?
You could say that he calls America's achievements miraculous. He points to the fact that the country has created $90 trillion in wealth, essentially from scratch.
Wow.
in just a few centuries.
That's mind-boggling, and he emphasizes that this wealth creation isn't just some abstract economic theory. It directly impacts everyone's lives.
Exactly.
Oh,
He famously said, babies born in America today are the luckiest crop in history.
yeah.
It's a powerful statement about the opportunities that exist in this country.
And it ties into the long-term performance of the stock market. The Dow Jones went from 66 to over 19,000 in the 20th century. A pretty good run, wouldn't you say?
To say the least, and the trend continues, but Buffett is also a realist. He knows that market declines and even panics are bound to happen.
He even quotes Meg McConnell of the New York Fed, who said, "We spend a lot of time looking for systemic risk in truth. However, it tends to find us sobering words."
The takeaway here, don't panic. Those periods of fear are actually opportunities for long-term investors. That's when you can find bargains while others are selling.
Buffett stresses that your own fear is the real enemy, not the market itself, especially if you've got a sound investment strategy.
Which he outlines pretty clearly: low-cost index funds and holding great businesses for the long term, simple yet powerful.
Now let's tackle a topic that sparks a lot of debate: share repurchases. Are they good, bad, or somewhere in between?
Buffett acknowledges that it depends on who you ask for. Shareholders who are selling buybacks are a plus. It adds another buyer to the market.
But for long-term holders, the math is different, right?
Absolutely. Buybacks only benefit continuing shareholders if the shares are purchased below their intrinsic value. Otherwise, they actually destroy value for those who stick around.
So it's all about the price. And Buffett points out a rather strange tendency among companies.
They rarely say what price is too high for a buyback. It's as if price becomes an afterthought, which wouldn't happen if they were buying a completely different business.
Interesting point. Buffett also outlines two scenarios where buybacks might not make sense, even if the shares are underpriced.
If the company needs cash for operations or has a better investment opportunity, buybacks take a back seat. Berkshire's policy is clear. They only authorize buybacks when the price is significantly below their estimate of intrinsic value.
Now let's address the elephant in the room. Some people argue that buybacks are un-American, that they divert money from productive investments.
Buffett disagrees strongly. He says both companies and investors are overflowing with cash right now, looking for good places to put it to work. He's essentially saying don't blame buybacks for a lack of investment opportunities if you've got a great idea. Let's talk.
Makes sense. So the takeaway for our listeners is this: pay attention to the price when a company is buying back shares. If it's a bargain, it can be beneficial, but if they're overpaying, it's a red flag.
Now let's shift gears and explore Berkshire's most important sector, insurance. This is the engine of their growth, and it all started with the acquisition of National Indemnity back in 1967.
A game changer for sure. And the key reason they love the insurance business is the concept of float.
It's pretty simple, actually. Insurers collect premiums up front, but they pay claims later.
Yeah.
This creates a pool of money, the float, that they can invest for their own benefit while waiting to settle those claims.
And Berkshire's float has grown to mind-blowing proportions, right?
Over $91 billion in 2016. It's like having access to a giant low-cost line of credit that never runs out. It gives them tremendous financial strength and flexibility.
But it's not just about the size of the float, is it? You need the right people at the helm.
Absolutely. You need exceptional managers who understand risk and run disciplined operations, and Berkshire has some true all-stars in this area.
Let's start with Ajit Jain, the head of Berkshire Hathaway Reinsurance Group. He's a legend, right?
He's incredible. He insures risks that nobody else will touch,
Wow.
combining capacity, speed, decisiveness, and most importantly, brains. The remarkable thing is he had zero experience in insurance when he joined Berkshire.
Talk about seeing potential. Buffett even jokes that he'd swap places with Ajit if a clone was available.
Then there's General Reit, formerly led by Tad Montross and now under the capable leadership of Kara Rigel.
Okay.
These folks know that sloppy underwriting can wipe out any benefits from the float.
Buffett outlines 4 disciplines that every sound insurance operation needs. First, understand all the potential risks.
Second, assess how likely those risks are and how much they could cost. Third, set premiums that will generate a profit.
And fourth, perhaps the most important, be willing to walk away from bad deals.
That's where many insurers stumble. They get caught up in the competitive frenzy and forget about the fundamentals.
And finally, we have Geico, the company that still sets Buffett's heart afire. They're a household name at this point, thanks in part to their clever advertising.
Led by the legendary Tony Nicely, Geico's business model is built on low costs, which translates to savings for customers. It's a classic competitive advantage, and it's created a moat that's tough to cross.
And their growth has been phenomenal. Their market share has gone from 2.5% to 12% since 1995.
Buffett even has a direct message for our listeners. At least 40% of the people listening to this can save money by insuring with Geico.
He even encourages people to stop what they're doing and call Geico right now. That's confidence.
But it's not just hype. Geico's success proves the power of a simple yet enduring competitive advantage. And that advantage is only going to get stronger as they continue to gain market share.
Okay, time for a quick recap before we move on. We've seen how Berkshire's intrinsic value is often hidden from plain view and how their focus on the long game drives their decisions.
We also explored the Dexter shoe debacle, proving that even the best investors make mistakes. And we got a glimpse into Berkshire's insurance empire with its massive float and exceptional managers.
Now, are you ready to dive deeper into the world of railroads, utilities, and some accounting tricks that companies use? Let's go. All right, let's shift tracks now and talk about those regulated giants in Berkshire's portfolio. BNSF, the railroad, and Berkshire Hathaway Energy, the utility company, they're a bit different from Berkshire's other holdings, right?
That's right. These are businesses that require massive upfront investments in assets that are built to last for decades. Tracks, locomotives, power plants, transmission lines, you name it. And to finance these projects, they often take on a significant amount of debt.
Debt can be a bit unnerving for some investors. What's Buffett's take on that?
He emphasizes that both BNSF and Berkshire Hathaway Energy generate consistent earnings that allow them to comfortably service that debt, even during economic downturns. They provide essential services, rain or shine, recession or boom.
So they're not as susceptible to the ups and downs of the market as some other businesses.
Exactly. That stability is a big part of their appeal. Buffett even expresses confidence in the role of regulation in these industries.
Okay.
He sees it as providing a certain level of predictability and protection from excessive competition.
That's an interesting perspective. You often hear complaints about regulation being a burden on businesses.
It can be, sure, but
Yeah.
in the case of railroads and utilities, it also creates a more stable environment, which benefits both the companies and their customers.
Now, another thing that stands out about BNSF and Berkshire Hathaway Energy is their commitment to sustainability. They seem to be ahead of the curve when it comes to adopting eco-friendly technologies.
Absolutely. Berkshire Hathaway Energy, for instance, has made significant strides in wind power generation, particularly in Iowa. They've even promised to keep base electricity rates stable for Iowans until 2029.
That's quite a commitment, especially given how the cost of living seems to be rising everywhere.
It is, and BNSF is no slouch when it comes to efficiency. Either they can move a ton of freight, almost 500 miles, on a single gallon of diesel fuel. That's like driving a car from New York City to Cleveland on a single gallon.
That's incredible. It's clear that both BNSF and Berkshire Hathaway Energy are not just good for Berkshire, but for the environment and the economy as a whole. Now let's switch gears and talk about something that might hit closer to home for our listeners, those tricky accounting practices that some companies use to inflate their earnings.
Yes, the infamous adjusted earnings, often used to paint a rosier picture than reality.
Buffett has a few pet peeves in this area, specifically calling out the exclusion of restructuring costs and stock-based compensation. He argues that these are very real costs that shouldn't be ignored.
Right.
So let's start with restructuring costs.
Yeah.
Berkshire has been restructuring pretty much constantly since Buffett took over. They've never felt the need to treat these charges as something unusual or separate from their normal business operations. But some companies try to make investors look past these costs by presenting adjusted earnings that exclude them.
Which Buffett finds misleading. He argues that if there are truly major one-time expenses, companies should explain them clearly.
Yeah.
But don't create a fictional version of reality by constantly excluding ordinary business adjustments.
Now, what about stock-based compensation? This one can be a bit tricky to grasp.
It's essentially when CEOs tell their shareholders, don't worry about the stock options or restricted stock. It's not an expense, but of course it is an expense. You're using something of value company stock to compensate employees.
Buffett even uses a hilarious analogy to illustrate this point. He imagines an accounting lab where his minions come up with ways to artificially inflate Berkshire's earnings by reclassifying executive compensation.
It's a brilliant satire of the mental gymnastics that some companies engage in to make their numbers look better.
Buffett's stance is clear. If CEOs want to exclude stock-based compensation from their reported earnings, they should be required to explain their reasoning to shareholders.
It's all about transparency and honesty, which are cornerstones of Buffett's approach to business.
This reminds me of that classic accounting joke. A CEO is interviewing potential auditors and asks, what is 2 + 2 the answer that wins the assignment? What number do you have in mind?
That perfectly sums up the dangers of playing fast and loose with accounting rules. The truth has a way of catching up, and it's rarely pretty. Now, let's move on to a topic that's both fascinating and highly relevant to our listeners. Buffett's famous bet on the performance of hedge funds versus a simple index fund.
This was a classic showdown between Wall Street's high-priced talent and the humble index fund, a real David versus Goliath story.
Back in 2005, Buffett publicly challenged anyone to pick a basket of at least 5 hedge funds that could outperform a basic S&P 500 index fund over 10 years. He even put up $500,000 of his own money to sweeten the deal.
And who stepped up to the challenge?
Ted Seitz's Protege Partners, a fund-of-funds manager. He had a lot of skin in the game, so to speak.
So how did it all play out?
After 9 years, the index fund was crushing the hedge funds. It had a compounded annual return of 7.1%, while the hedge funds averaged a paltry 2.2%.
That's a huge difference. What was Buffett's point with this bet?
He wanted to demonstrate that high fees and complex strategies rarely lead to superior performance, especially when compared to a low-cost index fund that simply tracks a market.
And the worst part, the hedge fund managers involved likely pocketed millions in fees regardless of their poor results.
Buffett estimated that over 60% of the gains achieved by the funds of funds were siphoned off in fees. Imagine how much more the investors would have made if they had just stuck with the index fund.
It's like going to a fancy restaurant, paying a small fortune and leaving hungry. What a waste.
It really highlights the fact that complexity is often the enemy of good returns in the world of investing. Simplicity often wins out.
Now, Buffett does acknowledge that there are a few exceptionally talented investors out there who can consistently beat the market.
But they are incredibly rare, like finding a needle in a haystack. And even if you do find one of these superstars, their success often becomes their own undoing.
How so?
As their track record attracts more and more money, it becomes increasingly difficult to maintain those outsized returns. Buffett himself experienced this back in the 1960s and decided to close his investment partnership to new investors.
Interesting.
He realized the size would eventually hinder his ability to generate those high returns, and he wanted to protect his investors. Unfortunately, many fund managers don't learn this lesson. They get blinded by the lure of bigger fees.
So what's the main takeaway for our listeners when it comes to investing?
Stick with low-cost index funds. It's the simplest and most effective way to capture market returns without getting eaten alive by fees.
Buffett has a hero in mind when it comes to championing this approach. Jack Bogle, the founder of Vanguard and the pioneer of index funds.
He spent decades urging investors to embrace this low-cost strategy, and Buffett believes he deserves a statue for his contributions. Bogle helped millions of people achieve better returns without amassing a fortune for himself.
Which is a stark contrast to those financial elites who chase the illusion of something extra and end up wasting billions on fees.
It's a powerful reminder that the simplest solutions are often the best. Now, this next point is rather intriguing. Buffett shares an observation about human behavior that he's gleaned from years of giving investment advice.
I'm all ears. What's he noticed?
He's found that his friends with modest means are far more likely to take his advice and invest in low-cost index funds. But when he gives that same advice to mega-rich individuals, institutions, or pension funds, they almost never follow it.
It's as if they think their wealth entitles them to something more sophisticated, some secret strategy that's off limits to us mere mortals.
Exactly. It's as if they believe their wealth should buy them access to some secret sauce that guarantees outperformance.
But in reality, they're often just lining the pockets of these so-called hyper-helpers while underperforming a simple index fund. What a paradox.
Buffett estimates that this pursuit of superior investment advice has cost the wealthy elite over $100 billion in the past decade alone.
And a lot of that damage has been inflicted on pension funds for public employees, leaving taxpayers to make up the difference. It's a classic example of human behavior trumping logic and evidence.
Now, it's not all criticism of Wall Street. Buffett also extends an olive branch to his friends in the industry. He acknowledges that Berkshire gladly pays hefty fees to investment bankers who bring them acquisition deals.
So they're not completely anti-fees.
Exactly. And they've also paid substantial sums for outperformance to their 2 in-house investment managers.
Interesting.
Buffett's point is this: when those fees deliver actual value to Berkshire, he's more than willing to write a big check. He's not against fees per se, just fees that don't justify the results.
It's a nuanced perspective. Even the staunchest critic of Wall Street excess recognizes that there are times when those fees can be justified. Now, let's shift gears and dive into another segment of Berkshire's empire, their finance and financial products operations.
This segment encompasses a diverse range of businesses, from furniture leasing to manufactured homes to railcar rentals.
It's a reminder that Berkshire isn't just about insurance and stock picking. They have a knack for finding profitable niches in all sorts of industries.
One of the standouts in this segment is Clayton Homes, America's largest home builder. They primarily focus on manufactured homes, which are a significant part of the affordable housing market in the U.S.
Berkshire acquired Clayton back in 2003, and it's been a fantastic success story. They've expanded their operations, grown their workforce, and even branched out into building site-built homes.
Their earnings have also benefited from the historically low interest rate environment. They hold long-term fixed-rate mortgages while borrowing at short-term rates, which creates a nice spread.
Now let's talk about another company in this segment, Marmon, which has a significant rail car business.
They faced a slowdown in demand last year as fleet utilization dropped. It's a reminder that even the best-run businesses can be affected by cyclical downturns.
But Buffett remains optimistic about their long-term prospects as they specialize in tank cars, which are essential for transporting various goods.
He even hinted that they're looking to expand their railcar operations in the future. Now let's turn our attention to another intriguing aspect of Berkshire's portfolio, their investments in publicly traded stocks.
We're not talking about the businesses they own outright, but rather their stock holdings in other companies.
And Buffett provides a glimpse into their top holdings, which is like a who's who of American industry. At the top of the list by market value is American Express, followed by Apple, Coca-Cola, and Wells Fargo.
It's a reminder that Buffett is a believer in owning shares of great companies, especially when they can be purchased at attractive prices.
And he particularly likes companies that actively repurchase their own shares, especially if those repurchases are done at prices below intrinsic value.
It's like the companies themselves are recognizing that their stock is a bargain.
Exactly.
Now, Buffett also addresses a misconception about their investment philosophy. Some people assume that Berkshire holds certain stocks forever, never selling no matter what.
But Buffett clarifies that they haven't made any such promises. Every investment is potentially for sale, even if the likelihood of selling seems remote.
It's a reminder that even the most steadfast, long-term investor recognizes that circumstances can change and flexibility is important.
Exactly.
Now let's delve into a topic that might surprise some investors, the tax advantages of dividends for corporations.
You might think that capital gains are the preferred route to tax-efficient returns, but that's not always the case for companies like Berkshire.
Why is that?
Well, every dollar of capital gains is taxed at the full corporate income tax rate, which is currently 35% at the federal level, plus any state income taxes.
Ouch.
But dividends received from U.S. corporations are taxed at a much lower rate, often as low as 7%.
Interesting.
That's because the company paying the dividend has already paid corporate income tax on those earnings, so it's a way to avoid double taxation.
It's a nuance of the tax code that can have a big impact on Berkshire's overall returns. Okay, before we move on to the final part of our deep dive, let's do a quick recap of what we've covered so far.
We started by exploring the unique characteristics of Berkshire's regulated businesses, BNSF and Berkshire Hathaway Energy. Then we unmasked some common accounting tricks that companies use to inflate their earnings.
We also delved into Buffett's famous bet on index funds, which highlighted the power of simplicity in investing, and we explored Berkshire's finance and financial products operations as well as their stock portfolio.
Now, are you ready to wrap things up with some final insights from Buffett's 2016 letter, including his thoughts on long-term thinking and the importance of financial education? Let's dive in.
All right, we've covered a ton of ground already, from hidden value to accounting shenanigans. But before we wrap up our deep dive into Buffett's 2016 letter, I want to circle back to something he emphasizes throughout the importance of thinking long term.
Yeah, it's a recurring theme in his letters, and it's woven into the very fabric of how Berkshire operates, both in their investment philosophy and how they manage their businesses.
Buffett constantly reminds us that the market will have its ups and downs. Short-term fluctuations are inevitable.
But over the long haul, the American economy has shown incredible resilience and a remarkable ability to create wealth. So don't get spooked by the headlines. Don't panic when the market takes a dip. Stay focused on the fundamentals.
So what's the key takeaway for our listeners?
Find great businesses, buy them at sensible prices, and hold them for the long term. It sounds simple, but it requires patience and discipline, two qualities that are often in short supply these days.
In a world obsessed with instant gratification and short-term gains, Buffett's long-term perspective is a refreshing antidote. It's a reminder that true success, the kind that lasts, is often measured in decades, not days or weeks.
It makes you wonder, In a world so focused on the short term, is that long-term perspective the real key to both financial success and a healthier society? Something to ponder, wouldn't you say?
Absolutely. Well, that wraps up our deep dive into Warren Buffett's 2016 letter to Berkshire Hathaway shareholders. We've covered a lot of ground today, from their impressive financial performance to their unique approach to insurance and their contrarian views on investing.
We hope you've gained some valuable insights that you can apply to your own financial journey. And if you're eager to learn more, we highly recommend checking out the full letter. You can find it online with a quick search.
It's packed with wisdom and insights, even if you're not a financial expert. It's a great reminder that the principles of sound investing are timeless and accessible to everyone.
So thanks for joining us on the deep dive. We'll catch you next time.